guys, in this video, we're going to talk about the Diamond Bull strategy. Now, that's a name that's basically I just made up because I don't really think there's a specific name for this strategy, and I don't really see a whole lot of people using this. But it's more or less just a three-legged strategy, and it's just we are very bullish, but we're using a short option to kind of pay for a debit on the other side. You'll see what I mean here in a second. So it's a three-legged strategy, okay, and it's going to use a debit call spread. So we're going to go in here, and I usually like to do this. I like to purchase an out of the money debit spread when I do this. Okay. So we're going to go ahead and we're going to sell right around, let's just take this 26 delta. That's a little far out for me, but I want to be around $2 wide. So we are selling this 26 delta debit spread. I'm sorry. We are purchasing this 26 delta call spread here. And you can see that our max profit is right around 160, and we are selling it for, or we are purchasing it for around 40 cents. So we're purchasing this for 40 bucks. Our width of our strikes is 2. So we minus the 40 from the 2. That gives us 1.6. That's how we have our 160 of max profit. So what we're saying is that we need Tilray to go above 22 so we can realize this max profit by this certain amount of time. Okay. And now what we're going to do is we're going to double down on our bet, but we're also going to utilize a short option to pay for that 40 cents. So when you use this, you want to do it in something that's relatively low IV, and you want a little bit of a skew to the put side, but it doesn't really have to be. And you have to do it in a stock that you don't mind getting assigned those 100 shares. Okay. And so usually it's going to be something that's relatively pretty cheap or low, you know what I mean? But you can do it when whatever stock you want to. So what I like to do is I like to come in here and then I want to sell. Let's just start off with the correct amount. Okay. So we're paying 40 cents for that debit spread. So right now, I'm going to get as close to 40 cents as I can on my put side and sell that option and see where we're at. So we'll go ahead. We'll sell this 15 for 32. Okay. So right now you can see our max profit is 197. Probably a profit's only 29%. And obviously we're long delta, and we have a little bit of short delta here because of that short put. But our delta is only 17. I don't really like that much. So we're just going to roll this up and we're going to see where it goes, because right now you can see that we're actually paying $3. Okay. It's only going to cost us $3 to put this on, but our max loss is going to be 100 shares at 15 here of Tilray. So, let's just roll this up and see if we can kind of get a credit. So here we go. We're right at the 16, and really that's a 25 delta. I want to go up here to this 35 delta. That's somewhere that's more comfortable for me. And we can get enough premium in here to where it's not a waste of our time. So what we're doing now is you can see, oh, sorry, I'm clicking the wrong buttons here. You can see that we're actually receiving a credit for this trade. And our max loss is going to be purchasing 100 shares of Tilray at 17 minus this credit received, which is 55. So that's our max loss, 1645. Our max profit is only 245. And that is what we will realize that if Tilray closes above 22 by May 21st. So this is a diamond bull spread, a double bull spread, super bull. You can call it whatever you want, but you're basically bullish on each side. But what you're doing is you're utilizing this short put to pay for this debit spread here. That's all that is. It's a really interesting way to trade. I enjoy it because you're sort of protected, and then your max loss. There's no risk to the upside here, right? You have no risk to the upside. Your max profit is capped because of this or because of this short call here. And your max loss is, I mean, who cares? You wanted to buy Tilray at 17 anyway. You don't want to buy it at 18. You know what I mean? So that's why you would utilize this strategy. Again, play it in somewhat sort of a low IV environment, because the low IV environments, the puts always trade richer anyway. So you don't mind always having a short put on. That's where all your risk is, because everybody wants the stock to go up. So if you sell a short put to pay for some sort of debit on the call side in a low IV environment, you're not getting ripped off at all, really, because the puts are always richer anyway, and you're already buying a call spread or a call for pretty cheap, so you don't have to worry about anything. That's basically all it is, just a call debit spread out of the money, and then you're just selling an out of the money put. and then you just kind of roll up and find a delta that you like. Obviously, you can do this wherever you want. I mean, if you were fine with that 16 or that 15 on Tilray, you know what I mean? You're only paying $3, but your max profit is 197. You know, that's perfectly fine. If you want to roll this debit spread down, if you like this closer in the money, that is perfectly fine too. You can put that long strike right there, right around 51 delta. You can roll this up right around that 35. You can see that we're paying 24 cents for this now. Max profits at 176. It's pretty versatile. You can do whatever you want in here, but I just like it because you are using this short put to your advantage. A lot of people don't understand how to do that, or why they would want to do that. They just go in here and they just buy this debit spread and they go, oh, well, I'm either going to make 160 or I'm going to lose $40. It's like, well, no, you don't have to. And really what I like to do when I like to utilize this, is that you kind of have to look at it as one trade, but sort of two different parts. All right. So what you can do is you can get a nice little run in here in Tilray. And so let's say in the next week or so, Tilray runs up, right? We're still 14 days from expiration, but Tilray runs up. It's already at 21. Well, what you can do is you can go ahead and take this debit spread off, take the profits, and you can either roll that down or just take it all the way off, whatever you want to do. And then all you have is that short put. And what you can do is either you can roll that short put up, or you can just go ahead and close out of that short put as well. So you don't really have to close all these three legs out at one time. That's pretty versatile. So if this goes up, right, Tilray's at 22, you have 14 days left. And then you just like want to roll up that put a little bit. You know what I mean? You want to roll the put from the 15 to 17, collect a little bit more premium. That is perfectly fine. And then once the expiration gets closer again, you can kind of roll out. It's very versatile. You can kind of do whatever you want. But again, all you're doing is you're just being super bullish on each side of the options chain, right? You're bullish on your puts and you're bullish on your calls. And you're just utilizing that short option to pay for the debit on the other side. So if you have any questions, feel free to reach out and I can kind of explain that further. But that is going to be our Diamond Bull strategy. Okay, guys, thanks for watching. Make sure to check us out on social media. We have attached links to our socials in the description, and we also have a swing trading service if you're interested. There's more information in the description below.